What if I told you the biggest lie in modern finance is the idea that banks actually need your money, that banks make their money by taking your deposits and lending them out? You think that that's true, right? That's what you were taught. Well, you'd be wrong because the truth is, banks today don't need you at all. They don't need your deposits. They don't need your savings. They definitely don't need your permission. They already have a direct pipeline to something much more valuable, the Federal Reserve, where they get paid interest on money that was printed out of thin air and handed to them for free. Yes, you heard that right. Because even if you've heard of fractional reserve banking and you understand it for the scam that it is, the truth is we no longer have the fractional reserve banking system. What you were taught about you depositing $100 in the bank, them keeping $10 of it and lending out the other 90, that no longer exists. The reserve requirements are officially zero. And while you're working, saving, hustling to build some kind of financial stability for you and your family, the big banks get paid billions just to hold cash on their balance sheet, cash that the Fed creates out of nothing and hands to them. And this is not some secret conspiracy. It's just the official design of our modern monetary system in 2025, a system where banks have the privilege of creating money out of thin air. The Fed prints more money to keep the banks liquid and then rewards them for hoarding as much of it as possible. And of course, none of that money goes towards directly benefiting you. It just quietly inflates asset prices and hands an even bigger slice of the pie to the people who already owned basically the whole pie. So in this video, I'm going to walk you through how the Fed actually creates money, how it pays banks to hoard that money, and why the entire setup feels a whole lot more like a wealth extraction scheme than some kind of mutually beneficial monetary policy. Get ready, because once you see this, you will not be able to unsee it. Real quick, before we get into it, my name is John from My Favorite Thing About Bitcoin. I started studying Bitcoin several years ago, created this channel with the goal of helping other people better understand and grow their conviction in Bitcoin. If that sounds like something you might be interested in, hit the subscribe button and let's go. Starting with the great reserve requirement myth. Yes, it's now become one of the biggest misconceptions in modern banking. The idea that your money is actually in the bank. We've always known 100% of it's not in the bank, but you probably thought at least 10% of it was, right? Wrong. Because yes, for most of US history, banks did have to keep a portion of your deposit on hand. It was called the reserve requirement, a kind of financial seatbelt. You deposit $1,000, they keep 100 in reserve and they lend out the rest. I mean, first of all, as if this wasn't already enough of a scam in and of itself, because 90% of the deposits were not at the bank. As Joe Bryan said when I interviewed him recently, it's just fraud. But if you thought that was bad, the truth of how it works today is much worse. In March of 2020, right as COVID hit, the Federal Reserve quietly did something pretty radical. It dropped the reserve requirement to zero, as in banks are no longer required to hold anything in reserve at all. This didn't really make giant headlines. It wasn't debated in Congress, but it changed absolutely everything. Because now banks can lend out every dollar they receive. There's no rule saying they have to hold anything in case you want your money back. And the kicker is, it's not like they came up with some other guardrail or way to punish banks if they hold too little reserves. They actually did the opposite. They created a system that incentivizes them to hold reserves by the Fed now paying them for holding more. How, you ask? Well, by flooding the system with reserves and then paying banks interest just for keeping that money parked at the Fed. So the old system said, be careful, you need to hold some cash. The new system says, here's a pile of cash, don't lend it out, just sit on it, and we'll pay you interest for doing that. Do you understand the sleight of hand that just happened there? We've gone from scarcity to abundance, but not for you, only for the banks. The sleight of hand that the banks were able to pull off was to say the reserve requirement system is not working. So they had it removed, but they didn't replace it with a regulation that makes banks be more responsible. Instead, they created an incentive for banks to hold more reserves by paying them free money not to lend it out. By now, I hope you're starting to see how the government money printer is a scam designed to enrich them and impoverish you. But I'm not done, not even close, because it's going to get worse. Let's dig in a little deeper and see how the Fed creates this money in the first place, and why, even though they say they made this system to protect the little guy, to protect Main Street, what it's really designed to do is to enrich Wall Street at your expense. All right, let's pull back the curtain on how the Fed actually creates this money that ends up as free interest for banks. You've probably heard this term. It's called quantitative easing, or QE. It's a fancy term for money printing, and it works like this. The US Treasury issues debt to fund government spending. T-bills, Treasury bonds, IOUs, whatever you want to call them. And then in order to maintain the illusion that the Federal Reserve is not directly funding the government, the big banks like Goldman Sachs, JP Morgan, Citigroup, etc., step in and buy those bonds at Treasury auction. They're known as primary dealers, and it's a very cozy inside club that only a few people get to be a member of. But here's where it gets really goofy. Soon after they do that, the Federal Reserve steps in and buys those exact same bonds from the banks at higher prices, of course, using brand new digital money that didn't exist the day before. So the banks buy the bonds from the government, the Fed buys the bonds from the banks, and the banks walk away with a nice little trading profit. All of this happens in the so-called secondary market, which is just a way of pretending that it's not money printing to fund government spending. But let's be real, because that's exactly what it is. The Fed creates the money, buys assets, and now the bank's accounts at the Fed are full of fresh reserves, which, remember, they get paid interest on. It's a giant circular loop. The government spends money, the Fed prints the money, and the banks always end up profiting. And of course, this is money that never goes into your wallet. It stays in the banking system. So now that the banks are sitting on mountains of reserves, digital cash in their accounts at the Fed, the banks then get rewarded for having that cash just sit there because the Fed pays interest on every dollar of it. It's called interest on reserves, or IOR, and it's the closest thing to free money in the entire financial system. You think about that for just a second. You deposit your money at a bank. The bank doesn't have to hold on to it. They can lend it out and make money on the loan. And whatever reserves they keep, the Fed pays them interest to keep. Risk-free. No customers needed, no loans made, no services provided. It's just, here, take this cash we printed for you, and while you're at it, we'll pay you to keep it. So where does the interest come from? It's not from tax dollars. The Fed just creates that too. More fresh digital money typed into existence. So now we have a system where banks are getting paid to hold money that came from the Fed, making profits on bonds they bought and flipped back to the Fed, and avoiding the risk of lending to you, because why bother at this point? They don't need your deposits. They don't need your business. They just need access to the Fed's money printer. And what does that mean for the rest of us? Because while banks are hoarding risk-free gains, regular people are getting crushed by rising asset prices, shrinking savings, and a system designed to keep the money up top. And apparently, it's not even helping you get a loan because they're incentivized to not loan it to you unless you want to pay an even higher interest rate, of course. So proponents of this BS claim it's all fine because it's not technically inflationary, because this money doesn't make its way into the system. But next, I'm going to show you exactly how QE widens the wealth gap and impoverishes you at the expense of making the rich even richer. So here is why QE pumps the rich and prices out everyone else. We've established that the Fed creates new money out of thin air, gives it to banks, and pays them to hold on to it. But that's just the very first ripple. The second ripple, the one that hits you, comes from what happens next. So it's technically true that the reserves created by QE stay inside the banking system. They're just numbers on balance sheets at the Fed. Banks can't lend those reserves directly to people or businesses. Reserves only move between banks, not into the real economy directly. So how does that new money creation end up affecting you? Mainly through interest rates and asset prices. Here's what happens. The Fed buys bonds. Bond prices go up. Yields, meaning interest rates, go down. That pulls interest rates across the entire economy lower. Mortgages, corporate loans, savings accounts. That makes borrowing cheaper, and it makes investors say, bonds aren't paying anything, I need better returns. So they start shifting money into stocks, real estate, private equity, commodities. And that new demand pushes asset prices up. So even though technically the QE money stays in the banking system, it reverberates outward by lowering returns on safe assets, pushing investors into riskier assets, and driving up the prices of everything they buy. And QE doesn't just inflate asset prices passively, it also supercharges the ability of rich people and institutions to buy even more of them. So if money is cheap to borrow, people with access to credit, i.e., the rich, borrow more of it. But what do they do with that borrowed money? They buy more assets, more stocks, more real estate, more companies, and more speculation. That borrowed money adds fuel to the inflationary fire. Now it's not just cash chasing assets, it's leveraged cash. This drives prices higher, faster, and the people who benefit most are those with collateral to borrow against and those with the financial sophistication to navigate debt and asset classes. Meanwhile, the average person doesn't have assets to leverage, can't borrow at low rates, and see housing just get more and more expensive, rent go up, and wages lag behind. So QE isn't just money printing, it's a wealth transfer engine fueled by cheap credit and rising asset prices. And that's why the rich get richer. They own the assets, so when QE pumps prices, their wealth explodes. You don't see money printing in your bank account, but you do see it in your rent, your grocery bill, and your inability to afford a home. QE doesn't hand you money, it hands money to people who already own everything and pushes you further away from owning anything. That's why every QE cycle has been followed by massive bull runs in everything from the S&P 500 to suburban home values. The people who already own the assets, they made a killing. And the people who didn't got priced out more and more. And the part that stings the most, this is not a bug, it's a feature. The Fed wanted higher asset prices to boost confidence, boost spending, and boost borrowing. But the side effect is a widening wealth gap that almost never reverses. So while the banks cash interest checks and investors ride the rocket ship, renters face soaring housing costs, savers earn basically nothing in terms of interest on their savings, and younger generations get locked out of ownership almost entirely. So what happens when this all gets too out of hand? It's helping Wall Street, it's hurting Main Street. So what if the cries get too loud and the Fed actually tries to stop? Well, it turns out at this point, that's basically impossible because I'm about to show you why the entire system is now trapped on a never-ending hamster wheel. Because at this point, the pain of unwinding QE might be even worse than having done it in the first place. So here's why the Fed is stuck, trapped, and cannot quit the game of doing more and more quantitative easing. They've built a machine that only runs in one direction: more reserves, more liquidity, more support for asset prices, and the moment they try to unwind it, markets absolutely freak out. We've seen this before. It's called the taper tantrum. Back in 2013, the Fed hinted it might slow down bond purchases. Not stop, just slow down, and markets panicked. Yields spiked, stocks wobbled, and suddenly everyone realized this entire system is addicted to Fed support. Because if the Fed raises rates too much, the interest it pays on reserves explodes, meaning it's literally paying banks billions more out of thin air just to hold money. And if it sells off bonds, it drives prices down and crashes the very markets it was trying to prop up. If it stops QE, the wealth effect disappears, and that could tank spending, confidence, and even employment. It's a lose-lose game. They either keep printing and risk long-term distortion, or they pull back and they trigger short-term chaos. But the banks, they don't care at all because they win either way. They're already insulated by reserves, interest payments, and risk-free trades. And regular people are left in a world where everything is more expensive and the so-called normal economy never really comes back. Remember when inflation was transitory? Yeah, exactly. So the Fed is stuck, the banks are very comfortable, and you are left wondering how a system this broken still calls itself stable. And there's one last piece we haven't covered yet, which is what happens when inflation does show up and who gets blamed for it and who escapes it untouched? Because that's the final gut punch. So let's say inflation does finally show up in the made up, juiced up, manipulated CPI numbers. can watch this video right here if you want to learn more about that. But like it did big time after COVID, right? Prices spike, groceries, gas, rent, everything starts to feel heavier and more expensive, and your paycheck does not keep up. So what does the Fed do? They panic, they raise interest rates fast and hard like they did in 2022. But remember what that means in this system. Banks get paid even more on their reserves because higher rates mean higher interest payments from the Fed, and borrowing becomes more expensive for you, like credit cards and mortgages and student loans all go up. And asset prices may start to wobble a little bit, stocks, crypto, and housing. And then, of course, after a decade of deliberately inflating asset prices, the Fed shifts the blame. Suddenly, it's not about QE or zero reserve requirements or risk-free cash parked at banks. It's about workers demanding higher wages and consumers needing to cool down. They'll flip the narrative on you overnight, and the very people who never got to benefit from the cheap money are then get told to take the hit. Raise rates, cut spending, lose jobs to slow down the economy. Meanwhile, the banks are still collecting interest, still insulated, and still winning. It's like a magic trick. Conjure the money from nothing, float it to the top, and then blame the bottom when the system starts to shake. And the question that nobody in any position of power seems to want to ask, if this whole system was designed to protect the banks and inflate asset prices, what would a system look like that actually served you? Because that's what I want to talk about next. I'll show you what an honest, sane alternative to this could look like and why this rigged game might finally be running out of rope. So we just walked through how the Fed creates money, how banks turn it into profit, and how everyday people are left holding the bag. And this whole setup feels rigged because it is, but it didn't have to be. What would a sane, honest system actually look like? Maybe we start here, we stop paying banks to hoard money. If they're going to print money, like they say they absolutely have to, what if it served the people, not just the balance sheets of the financial giants? What if there were real accountability and transparency? No more rate hikes that reward banks behind the scenes, and no more offloading bad assets onto the Fed's balance sheet while pretending it's just monetary policy? And what if we built systems that rewarded actual value creation, not just proximity to the money printer? Those of you who believe we absolutely have to have 2% inflation or the entire economy will grind to a halt, what's your explanation for why that money printing has to benefit big banks and rich elites and grind the middle class into a pulp along the way? No. Don't you see what's happening? If a small group of people gets to control the money, they will always tilt the board in their favor. The entirety of human history tells you there's no such thing as human-controlled monetary systems that go uncorrupted. It's very tempting for them to say, don't worry, we'll do a better job next time. It'll be more fair. Inflation is transitory. We'll just tweak the rules so that we get it right next time. But that's just trying to tweak the rules while still playing inside the same broken game, also known as rearranging the deck chairs on the Titanic. Because as long as someone can print money, they will, and it's always going to benefit those closest to the printer. So the real fix is take the printer away. The deeper truth isn't that we need better central bankers. It's that we don't need them at all. We shouldn't have to trust a committee to decide how much your dollars are worth this year, how much your savings is worth, how much your time is worth. The dollar, in case you didn't know, lost 10% of its value in the first half of 2025, the largest 6-month drop in decades. And that's just measured against other dirty debasing fiat currencies. If you measure it against the longest standing historical real store of value, which is gold, the dollar lost 26% of its value in the same time period. Tell me again how inflation is only 2% or how it's transitory. We shouldn't have to sit around and hope that unelected officials won't juice the system for Wall Street again and again and again. We shouldn't have to sit and wonder who gets bailed out next and who gets left behind. Or more accurately, how far behind are you going to get left? Money should be neutral, predictable, transparent, outside the reach of politics and manipulation. That's the whole idea behind Bitcoin. It's not a get-rich-quick scheme. It's a monetary firewall, a system where no one can tweak the supply behind closed doors, no insider access, no secret bailouts, and no printing to profit one group at the expense of another. Sound money is about leveling the playing field, not tilting it further with every new crisis. Like I said, history shows us that every time you give a small group control over the money, they're going to use it to benefit themselves and those closest to them. It doesn't even have to be about bad people. It's just bad incentives. So maybe the future is not a better Fed. It's a world where no one is charged with doing what the Fed does now. That may sound radical, but it's not. It's rational because power corrupts and absolute monetary power corrupts everything. Technology has helped us reach a turning point. It's able to challenge the monopoly that banks and central banks have on the money. People are asking questions and being given tools that they've never had before in human history, and the credibility of the central banks is eroding fast because the system that they built can't go on forever. At some point, the imbalance gets too big, the debt gets too big, the wealth gap too wide, and the asset bubbles too inflated. And then trust collapses. So the question then is not what happens if the system changes, it's how and when and whether you'll be ready when the entire game resets. If this video helped you see the current system more clearly, share it with somebody else who thinks the Fed still has everything under control. Hit the like button, subscribe to the channel, dive into this playlist here where I talk more about why Bitcoin is the solution. And as always, you never forget, Bitcoin is inevitable.